Welcome back guys to another Zero DTE video, and today Ernie's going to talk about the out of the money Iron Fly, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to Ernie's course. And as always, I hope you enjoy guys.
Now, let me just describe what that out-of-the-money strategy might look like. Now, there are a number of ways that you can do it. You can use it as a market-agnostic strategy, or you can use it as a directional strategy. Let's look at the directional strategy first. So if this is at the money and you anticipate that price is going to go up, now, of course, price could also go down. But let's say that you anticipate that price is going to go up, then you would put an out-of-the-money fly. Now, when I put this on, you'll see it's very different than what you saw with the at-the-money fly. Look like this. Right. So the first thing you'll notice is that the risk is super small. The second is that you'll notice that the center strikes are out of the money. That means that price needs to go in that direction. Where the Iron Fly strategy really requires you to take quick profits because you can't stay in the trade too long for fear that it's going to and will eventually go into a negative situation. This strategy, you don't have to worry about that at all. Now, the real-time profit curve on this guy will look like this. In some markets, in other markets, it might be greater. But eventually, this profit curve is going to fill up and become the at expiration, eventually, by the end of the day. And so that means it's going to grow from this to this over that day. Now, of course, that requires you to go this way. If you go this way, you're SOL. That's a loss. If you go this way, you can manage a win, right? Now, the key here is that, yes, your win rate isn't going to be 90, 95%. It's going to be probably closer to between 45 and 55%. However, the distribution of your returns are going to be very, very different. And the scalability is inherent in this type of trade. In other words, it's easy to scale this to go after much larger profits simply by increasing your risk a little bit and the size of your flies. So you can see here, let's say that this is 1 and this is 10. If I wanted to make that 20, I just bring it up to 2, and then this becomes 20. Whereas on the other strategy, if you're starting out at 3,000 and you're trying to make 150, let's say, okay, to make it simpler into similar terms, 30 to make 1.5. If you want to make 3, you have to turn this into 60 or 6,300. Your ability to get to that is going to require a monumental increase in the amount that you want to put up for risk. So you can see that the out of the money fly is way more scalable, way more efficient with your use of money. Having a win rate of say 50% isn't so bad. You're not giving up a lot in terms of percentage wins for a far greater use of your capital. And in fact, in the long run, this low win rate has a much higher long-term expectancy than this high win rate. I know that at the outset, that might seem not very intuitive, but that is the case.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.